Forget tech stocks, forget crypto for a minute. The most intense corporate battle being fought right now is, believe it or not, over your trash. In one corner, you've got this sprawling empire, and in the other, a super disciplined federation. Today, we are diving deep into the surprisingly high-stakes world of waste management to see who's really winning the trash wars.
I mean, it sounds simple, right? Pick up trash, make money. But the answer to that question reveals two totally different philosophies for building a billion-dollar empire. We're going to rip open the financial reports of these two giants to figure out who's built the smarter, more profitable money machine. Okay, so on the left, we've got Waste Management, or WM. They are the industry's undisputed empire, pulling in a massive $25 billion. But then, on the right, you have the challenger, Waste Connections, WCN. Now, yeah, they're smaller, but just look at that EBITDA margin. For every single dollar that comes in, they're generating more pure operational cash, a stunning 33%. That's way more efficient than the bigger guys. So how on earth is that possible? Well, it all comes down to their playbooks. You see, even though they're on the same field, the Empire and the Federation are playing two completely different games. Let's break down exactly how they do it. So, WM's whole strategy is about sheer size and power. It's brute force. They use North America's largest network of landfills and transfer stations to just dominate the big, lucrative city markets. And man, are they pouring money into tech, automating recycling plants to cut down on labor costs, building a whole fleet of facilities that turn landfill gas into clean energy. And when they decide to grow, they don't just expand, they conquer, like with their monster acquisition to get into the healthcare waste business. WCN's approach? It cannot be more different. They absolutely refuse to get into a brawl with WM in the big cities. Instead, they strategically pick off smaller, rural, and secondary markets where they can lock in exclusive franchise deals. That gives them a virtual monopoly. They push power down to the local managers, building a fortress not with overwhelming force, but with smart, highly defensible positions. And this chart, wow, this shows you the brilliant result of that strategy. Because WCN operates where there is less competition, they have incredible pricing power. They could jack up their core prices by 6.5%. WM, on the other hand, is facing all that fierce competition in the big cities, so they could only increase their overall yield by 3.8%. In a world of rising costs, that difference is a massive, massive advantage for WCN. So we see the strategies are totally different, but how does that actually translate into the final numbers? I mean, how do they build their money-making engines? Let's pop the hood and take a look. All right, to really understand these engines, we're going to use a key metric called return on equity, or ROE. The easiest way to think about it is like a car's horsepower. It tells you how well a company uses investor money to make a profit. And you can get that horsepower two ways. You can have a naturally powerful, high-margin engine, or you can bolt on a turbocharger, using debt to amplify your returns. And this table, it just decodes their horsepower perfectly. WCN is your classic internal combustion engine. Its power comes from pure, high profit margins that it squeezes out of those exclusive markets. WM, on the other hand, is turbocharged. Its profit margin is a little lower, so it uses financial leverage, that's debt, to boost its returns. See? Two really powerful engines, just engineered in fundamentally different ways. Now, a look at WCN's revenue mix just confirms this laser focus. Over 56% of their business comes from their core commercial and residential collection. This is their bread and butter, the source of that high-quality, high-margin profit engine. They really stick to what they know and what they can completely dominate. Now compare that to WM. It is a much more diversified empire, right? Disposal and transfer are huge, which makes sense given their massive network of landfills. But do you see that new 10% slice for healthcare? That's the direct result of that huge Stericycle acquisition. It's a perfect picture of their strategy. Grow by buying your way into totally new, related businesses. You know, a company's strategy isn't just about what they're doing today. It's about where they're placing their bets for tomorrow. And here again, our two kings are betting on very different futures. WM is betting big, and I mean big, on technology. Just look at this number. That's how much they invested in a single year on sustainable growth. $633 million. That is a massive bet. So where exactly is all that money going? Well, it's going into building a high-tech fortress. They are creating fully automated recycling plants to slash labor costs and constructing this massive network of facilities to convert landfill gas into valuable renewable energy. WM is using its immense capital to build a tech advantage that they hope no one else can ever match. WCN, in stark contrast, is betting on its people. And their key metric is this one. They have cut voluntary employee turnover by more than 50% in just a few years. In an industry that's plagued by high turnover, that is an absolutely incredible and very, very profitable achievement.
They do this through a culture they call servant leadership, which is all about prioritizing their employees' well-being and giving them real power. And let's be crystal clear, this isn't some feel-good HR initiative. It is a core financial strategy. Lower turnover directly means lower recruiting and training costs, more experienced drivers, and ultimately better, more efficient service. It's a moat built out of people, not just machines.
And their future bets are perfectly summed up in how they buy other companies. WM goes whale hunting. They make one massive $7.2 billion deal to instantly become a huge player in a new field. WCN, though, they act like a piranha swarm, executing 43 smaller, strategic tuck-in deals to just gobble up local competitors and strengthen the territories they already have. Two paths to growth, both can work, but they are wildly different. So, we've seen the playbooks, we've looked under the hood at the engines, and we've checked out the future bets. I think it's time for the final verdict. Here is the official HDIN Research Analyst scorecard.
All right, let's break this down. For pure profitability, WCN gets the A+, no question. Their niche strategy gives them that unmatched pricing power. On strategy, it's pretty close, but they win in different ways. WCN with its local fortress, WM with its unbeatable scale. In capital efficiency, WCN's high-quality profit engine wins out. But when we look at future bets, WM's huge tech play gets the higher grade. And finally, the risks are pretty clear. WCN has to keep integrating all those small deals, while WM has to manage its huge debt and these massive new acquisitions.
So what's the ultimate takeaway here? Our final analyst view really puts it this way. The Empire, WM, is a stock for investors who want stability, who want dividends, and the safety that comes with massive scale. The Federation, WCN, is for investors seeking higher growth and superior profitability, but you have to be willing to accept the risks that come with a strategy built on constant deal-making. There is no single right answer here, only the right fit for your portfolio. So the war for your trash is really a classic battle of scale versus strategy, technology versus culture. One is building an unbeatable machine, and the other is building an unbeatable team. Who will win isn't just about who's bigger, but whose strategy is better built for the road ahead. For more in-depth analysis just like this, get in touch with us at HDIN Research.